Good afternoon, everyone. I am Tanya Scott Pilcher, and welcome to Financial Sense. It is awesome to have you with us this afternoon. Every Friday, we are here providing you information regarding the things that we do wrong with our finances and trying to help you get them right. So, I am looking at myself here all by myself, waiting on my co-host to come and join me today. But we're going to have an awesome show. Again, my name is Tanya Scott Pilcher, and I am with Get Skills. And Get Skills is an insurance training academy where we help people that want to get into the insurance field. This is a $1 trillion industry. And this $1 trillion industry can make a career that you would be so happy with for the rest of your life. But the one thing that you have to do when you're getting into insurance is that you have to take an insurance exam. And in order for you to take that exam, you are required to take a 40-hour course. And so that's whether you want to get in life and health or property and casualty. And right here in Savannah, Georgia, we offer those classes to you. As a matter of fact, we have one coming up on August 31st, from August 31st to September 3rd. So the 31st, the 1st, 2nd, and 3rd, that we're going to be offering that class. And we're going to do it in 4 days. The cost for the class is $240, a small investment in your future. And we want to invite those that are interested in getting your life and health, and those that live in the wonderful city of Atlanta, Georgia. We have classes there too. We have an office in Lawrenceville. And in Lawrenceville, we will have a class on Saturday and Sunday, August 28th and 29th. And then again on September 4th and 5th. So that's when our classes will be held. We invite you to join in. If you want to get more information regarding those courses, you can reach us at getskillstraining.com. Again, that's getskillstraining.com. So I have both my co-hosts, Mad Flo and Anthony Murray, will be with us shortly. And we have an awesome guest today. So last week, we had the opportunity to talk to Mr. Terry Clark, and he gave us a wealth of information. And then today, we have him coming back with us. So hey there, Flo, how are you today?
Hey, I'm doing great. I am a passenger. I switched over.
Absolutely. That is wonderful. So glad that you had a person to ride with you and that you could switch over.
Safest way to travel is always have somebody ride with you.
Absolutely. So how are you today, Flo?
Hey, I'm doing absolutely fantastic. I'm going to a training now in Miami. We'll be over there for the weekend, and that's the great part of having your own business is the fact that you get to travel, meet new people, do different endeavors. So I love the fact that I'm an entrepreneur and I get to travel as well as business.
Well, great. So, Flo, I've already, welcomed everyone, but why don't you go ahead and introduce yourself for today?
Hey, you guys, this is Mad Flow. I'm not crazy now. That just stands for making a difference for life and others. And I'm also in the financial industry. Been doing this since 2013. I love what I do because what we do, we teach financial literacy because that is the key to anyone's success is being financially educated. If you want to build your wealth, first build your knowledge of finance. That's what we do here on Fridays, every Friday at 1 p.m. So join us in, and also it's going to be on YouTube. This is an all things relevant media. So it's a platform that is geared towards educating those out there who want to learn. All right.
All right. So, And when is your next financial literacy class?
We have them every day, Monday through Friday, 2 p.m., 8 p.m., and 10 p.m. So today is Friday. We'll have one today. If you get on at 8 o'clock tonight, we'll have it at 8 o'clock tonight. So our next literacy class is 8 p.m. And this is the site that you want to visit. worldsystembbuilder.com/WS US www.worldsystembbuilder.com/WS-US and just register. But also when you go to that site, realize that the time is going to be in Pacific time. So just convert it to Eastern Standard Time. 11 o'clock is going to be 2 o'clock. 5 o'clock is going to be 7 o'clock. And no, 11 o'clock is going to be
3 hours. 3 hours.
3 hours. Just kind of 3 hours.
3 hours.
And I'm in finance. Woo! But you know what? It's a good thing. So y'all join in on the classes, the workshops. There's 5 workshops geared towards a different topic every day. So except Saturday and Sunday. So join in.
Yes, that is so awesome. So we are here today. We're going to be talking a little bit about Index Universal Life. Again, we had an awesome guest last week, and we're going to be bringing them back again this week. So we will introduce them shortly. So a little bit
not fixed. That's going to be indexed. Index Universal Life. So you guys got to know the difference. It's going to be an index. Talk about Index Universal Life.
Well, you want to describe what the difference is?
Yeah, the difference, let me tell you guys what the difference is. And the guy that's coming on today, very well versed in Index Universal Life policies. I mean, this is how you can really build your wealth. If you want to focus on building your wealth, understand Index Universal Life plans, because you know what? When we're introduced to insurance, most people just introduced to 2 types. Term and whole life, and we get it and we still don't understand it. But with the Index Universal Life plan, it's a whole new different animal, and this is one where it has flexible premiums, which basically means that you're able to overfund your premium, put more money into your plan, and guess where that money goes? That extra premium that you're putting into your insurance policy, actually what it's going to is to build the cash value. Now, the difference in the whole life and an Index Universal Life is basically this. You have a flexible premium. Okay, that's a great thing. So if you pay the target premium, let's say your target premium is $50 a month, but you want to pay more to go towards the cash value, you put an extra $25 in there. That extra cash is going to go directly to build your cash value. But what if you have a hardship and you say, you know what, I can't pay that $50 every month right now. I need to pay a little lower. So guess what? You can pay the minimum amount, which means you're going to go lower, but your plan will not lapse. So you have an opportunity to pay the target premium, to pay less than target premium, or you can overfund it over the target premium. Now, guys, listen to this. This is what is wonderful by Index, and understand it. If you're looking for some place where you can grow your money and not lose your money, you need to learn about Index. And what I'm talking about, not losing it. First of all, with the plans that we offer, you can get up to 15% interest growth on your money. So there you are, you're getting up to 15% because it's a cap. It's something called a cap. But then there's also something called a floor. That means no matter what happens to the economy. Now, 2020 was kind of a hardship for, the economy, really, really. But you know what? If you had an Index Universal Life plan, no matter how much money you had built up into that plan, it could have been $1 million, $2 million, $3 million. Guess you didn't lose not one dime. You didn't lose any of your money because the floor saved you. This guy's going to come on. He's going to get you to understand what a floor is. A floor is what saves you from basically the risk that's involved. Now, another thing is this. the plans have been averaging 7.10% for the last 20 years. So now you're going to learn about these plans. You're going to learn how to build your wealth within a life insurance plan. You're going to learn how you're not going to lose any money. You're going to learn how, if you want to borrow from that, if you want to pull from it, you're not going to do what? Pay taxes. So if you want to eliminate paying taxes legally, get to understand how indexed universal life plans work. There is whole life, there is term life, and I can guarantee you, everybody on this call right here, on this audience, they know about term, know about whole life. They get it, but they still don't understand it. But I guarantee you probably never heard of IULs and really get to understand how they work. I just want to put those tidbits in there.
And then, I've had some additional, let me see. I've had some additional that I had, some other people that wanted to do IULs. The other part of it is that you still have to be healthy and be able to. So it's not like you can just go in because you want to invest. You definitely still, this is an insurance policy, so you have to be insurable. And if you're insurable, then this is something that all of us need to do. I've done it for my children. I've done it for myself. And, it has been a wonder, a joy. Hi there, Mr. Clark. How are you today?
Hello today. I'm excellent today. How are you?
Excellent. So you got the ladies with you today. You have both myself and Mad Flo.
Hello.
Flo, you got some feedback, I think.
I'm gonna mute me.
Oh. So, Mr. Clark, Mad Flo I think you were here last week with Anthony all by yourself, but it's usually the three of us on here on stage with you. And so Mad Flo just kind of went over a little bit about IULs and the importance of them. So she was just warming up the audience for you to, talk a little bit more about what this is, how we can grow, and how important it is in our lives. So how are you doing this morning before we get off into, talking business?
Well, it's been a great day, just been busy. And so I apologize, running a few minutes behind schedule today. So happy to be here, to have this opportunity once again to participate in your program. So happy to be able to share some ideas, information about the IUL for all of us. It's so amazing that we have this tremendous product. We have this wealth building program that's changing the universe, and so many of us aren't really familiar with this concept. So a chance to really take advantage of really building wealth for middle America. So one of the greatest things we have in this country, again, is the IUL. So I'm just happy to be here today. Thank you so much for having me, and hopefully I can depart a little information to help folks see the value of having this in your portfolio, so that you and I can now start to help people understand how you can participate in this economy. So understanding how to grow money there, and the tax laws of this country is one of the things we are not really comfortable with a lot of times. We're not having the right research, having the right advisors. All those things are so important. So I think that if we could, I sent you an email with some information that and some of it we reviewed. But again, I'd just like to kind of update people on how it fits, and if perhaps we could put that on the screen, we could kind of give people a taste of, again, how the IUL can be a blessing to their family. Did we lose Tanya?
Hey, we're here, Anthony. Glad to have you on. We got it. Got the information. I I logged out for a minute. It just went blank. I just went out because I'm traveling. But Anthony's in the show.
Okay. Hello, sir.
I'm having problems getting in.
I see Mr. Murray.
You see me?
I do.
Okay, great. I'm trying to see you guys, but my computer is having a little there we go. There we go. All right. Don't know what happened to Miss Tanya. But yes, I was listening to you, and I was trying to get in on one area of my computer, and it just wasn't working for me. And so I said, okay, what are we doing here? Okay, so why don't we try to pick up where you left off as far as you can remember, and let's go from there. How's that?
It'd be my pleasure.
All right, because we talked about we talked about taxes and we talked about the using a bank strategy. There is just so much that you talked about. I can't recall it all, but well, I know about IULs because I sell them a lot. That's my go-to to help people, because it's like that knife in your illustration. And if Tanya, what happened to my Tanya?
Tanya lost signal.
All right. If Tanya could share her screen and bring that back up, that'd be awesome. I could actually, well, I don't have the information. I was going to say I could share my screen, but I don't have that information. So
I saw a question on the screen about the question that asked about the difference between an IUL and a UL. That's an interesting. That's a great question. A lot of folks are just not familiar with the difference. And of course, you know, in the evolution in the insurance industry over the last 20 years, we've seen the growth of these products. You've seen the growth of the insurance products. We know about the traditional whole life insurance that had guaranteed cash value, but no growth. Then we know that we had the introduction of the universal life product to the industry. That was a fixed interest product. It was not indexed to the market. It was just a fixed interest. So you have the traditional universal life, which again, I mentioned, is just a fixed interest product. So we still gave you some flexibility, gave you opportunity to have flexible premium and flexible death benefit. But again, it didn't really give you any growth. Then, of course, you know, you had variable life insurance, variable universal life, which was huge. It really swept the industry. It revolutionized the industry with variable universal life. So DUL is still around, of course. Of course, you know, that was an in the market product. So that product too allowed, it did offer you growth, but it also offered you risk. So the DUL was a great product. Again, allow folks to use a monthly premium, use the overfunding opportunity inside their life insurance plan to invest in the market. But again, as I mentioned, that product also gave you growth, but also risk. So you can have a loss. The index universal life transcended the market, and it gave you growth without a loss. So it indexed the market, not in the market. So it gave you the best of both worlds. It gave you the guarantees of traditional life insurance, plus the growth of investment life insurance. So now you have the Cadillac, the complete product in the industry. And this is why I really think that it really now needs to be a focus point for many Americans in terms of how you build wealth in this country. Being able to be indexed to the market, not in the market. Have a floor, basically have a guarantee, so that you have a guarantee of principal and guarantee of interest. And then on the top side, also being able to have growth up to a cap. So the IUL gave you the best of both worlds, guarantees and growth. So very pleased that that question was brought up, that what is the difference between a UL and a IUL? One is a fixed interest product, versus a index product. So fixed interest versus growth would be the answer to that question. And it's so very important that people understand that and do their research and talk with their advisor. And so we're just recognizing again the chance to really build wealth. Most folks that's not familiar with the marketplace. For instance, if you really are trying to grow money, you either have installment money or you have lump sum. So my very first question when talking to anyone is, what kind of money do you have? You have installment money or do you have lump sum? So if you only have installment money, what type of product can you put money in that will give you an opportunity to build wealth? So life insurance now is one of those traditional products that give you a chance to build wealth with installment money in particular. And also, if you have some money, it allows you to use overfund those products if you have lump sum. So both parties can participate in that product in terms of wealth building. So again, it's just really a tremendous product. It has so many features to it. And so we understand that in the insurance industry, you can build wealth using the IUL. We can show people if we had the video.
Okay.
I'm so sorry. So what it says? It says the power. Again, you're breaking up.
All right. What she's trying to say is that we were looking at a question from someone or a statement. They said that you should provide a case study on permanent life insurance. A case study.
Well, that could be another session. That certainly wouldn't be a problem. We all need to go back and understand permanent life insurance, term, and understand how insurance companies. Again, you get into a different world when you try to look back at case studies. But just talking about again the permanent life insurance, of course, we've been around for years, and that's in the insurance industry, and how that product is designed, how that product is the foundation again of your estate planning, and it still has a value today in many cases. But we want to just focus on the IUL and what it brings to the table, how you can use that to grow money, and then adding that to your portfolio. Because it starts with understanding it's still life insurance. That is first and foremost. And so the question is, does that person need life insurance? Once you solve that for that individual and they have proper protection, we could talk about then whether or not they also need to have any type of retirement income.
That's right.
Or money for education for their children. Or they need trying to build money for emergencies. Are they trying to really have any type of cash value? So the basics of the IUL is still the same because it gives you that protection. Not only does it give you protection in the event of death, of course, it also has living benefits. So you have this product that has 3 features.
Right.
Many folks, it's such a blessing to be able to get 3 for 1 for your money. I mean, anything you put your money in, if you can get 3, you get 3 for 1 type return. And so it's really so unique in the fact that not only am my family's protected in the event I die, again, die too soon. Those are the 3 principles of financial planning. If you die too soon, if you get sick, what if you die too soon? What if you get sick along the way? What if you live too long? So which of those most concern you? Well, most folks would say if I die too soon. But then that's where we want to be sure you have proper protection. And then you might say number 2 would be if I get sick along the way. Then we'll make sure you have long-term care protection, or you have some type of critical illness benefit that's going to pay you a lump sum amount of money in the event you have a heart attack, stroke, or cancer. And then of course, if I live too long, will I be able to retire comfortably? Will I have enough income in retirement? So again, the three principles of planning is one, making certain you cover those three financial concerns.
All right, what's the first financial concern?
Die too soon.
Say that again.
What if you die too soon?
Die too soon. The second one?
What if you get sick along the way?
If I get sick along the way, what's the third one?
Third one, what if you live too long?
Too long. All right. Yeah. Too soon, sick, and too long. All right. So those are the three things people really need to take into consideration when considering an IUL or even a UL for that matter.
That's correct. Yeah. That's the basis. Now, if you are independently wealthy, different story. So, I ask my clients again when I was, is whether or not are you independently wealthy? So question number one, are you independently wealthy? Yes or no? No, you're not independently wealthy. Then what if you die too soon? How do you plan to provide for your family?
Right.
Are you insured or are you self-insured?
Mm-hmm.
Well, if you're not insured, you're automatically self-insured.
Exactly.
So therefore, how much money do you have in the bank?
Mm-hmm.
So when you tell me you have $1,000 in the bank and you have no life insurance and you're self-insured, my question was, how do you plan to protect your family if you die too soon?
Exactly. Right.
So again, are you self-insured or insured? So once we get past understanding that part, making folks aware that they have to be insured to protect their family, that you can have $1 million life insurance policy to protect your family today with just one monthly payment versus being self-insured and leaving them zero. So do you really care? Do you really love your family, your children, or your spouse, or anyone? Now, if you don't, then of course, we are not a good fit. You need a different advisor, because I'm only interested in working with people that love someone.
Yeah. You know what?
Yes.
I was talking with someone the other day about coverage, and I'll tell you what, the show we had last week, even though I've been selling the IULs, the show we had last week just kept coming up in my head, in my mind, in my spirit. If you could say, like, if you don't mind my saying, like, and I just started almost reliving that show, talking to people. And so I'm hoping, and it seems like people are really starting to get a lot out of this. One of the good things about the IUL is that it gives you the opportunity to, if you are not financially wealthy, all right, it gives you the opportunity as a middle income or even a low income individual to put your money somewhere where it's going to start accumulating. And then the value of it is that you could accumulate massive amounts. All right. Now, what most people need to do, because a lot of people would love to have an IUL, but they don't think they could afford it. This is what you need to do. You need a personal financial analysis or professional financial analysis. What is that? That's when you have a finance professional, like me, Mr. Clark, Matt Flo, Tanya, and we have others that's online. That's professional. That's watching the show. Professional financial counselors and advisors, and they're just professional industry, like Mr. James Goodman. All right. You get something. You have the individual meet with this person so that they could identify where your money's going. because you'll be surprised how much money you're wasting. A lot of people are wasting money on what? They're wasting money on lunch. Nothing wrong with eating. Well, why don't you make lunch and bring it with you?
Very important.
You got those leftovers in the refrigerator anyway. All right.
Absolutely.
You know, people are spending $10, $15 a day on lunch. All right. So if you go $10, $15, let's just say 10, not even 15, 10, or let's say 7. All right. $7. All right. Or if they go to Cookout, $5 and some change. All right. But let's go $7, 5 times 7. That's 35 times 4. Now you're in 7 times 5, 35. Look, you're $200 and something. You have plenty of money. It's just the fact or problem of misallocated money. You have money available. Most people do. Even those that live in the hood have a lot of money available. You know what, Mr. Clark? I grew up in a ghetto. I grew up in the projects. And one of the things that used to catch me off guard is this. Living in the projects and watching people drive around with brand new Lincolns, brand new Mercedes, brand new, but they're living in the project.
Priorities. Their priorities upside down.
Priorities upside down. Their priorities are messed up.
Well, it's so amazing. Historically, if you look, you'd be surprised. Over the last 100 years, what are the top 2 saving vehicles in America? And a lot of folks have not done their research, and they don't know. Over the past 100 years, the top 2 saving vehicles in America is 1, home equity.
Home equity, right.
And number 2 is life insurance cash value. So again, just look at your history. Over the last 100 years, the top 2 saving vehicles are home equity and life insurance cash value. These are forced saving vehicles. You're forced to pay that monthly payment on your mortgage payment. You're forced to pay that monthly premium on your life insurance. So these forced savings program over the past 100 years are the top 2 saving vehicles in America. So what does that say? So when I look at your business plan, you tell me 1, you don't have a home, you don't have a home, you're not building a home equity, and then 2, you don't have any life insurance, you don't have any permanent life insurance, so you're not building the cash value. So help me understand over the next 30 years, what is going to make you save money? You have no forced saving vehicles, and without some discipline, like you say, spending that money on lunch, $300. My wife and I went out to have a nice dinner a day ago. We spent $20 just on one dinner. And you add drinks, plus you add dessert. It doesn't take in Atlanta. You really that's really not a bad price.
No.
So I'm just I just share that in event. But understand those about what 2 things have the most savings for in the last 100 years for America.
Hey, Pam Jones had a question. Pamela Jones. I asked the company yesterday and did not get a clear answer. If I add cash to my UL, will my face value increase, and will the extra cash grow as long as I meet the MEC?
That's a great question, but there's 2 answers to that. 1, does that product have an increase in face amount versus a fixed face amount?
Right.
And so if it has an increase in face amount, then yes, that cash value, that death benefit will grow. And so that your family will receive not only the death benefit, but they also will receive the equity in your product, your cash value account. So they get both. And then two, if it's not indexed to the market, then it's going to be a fixed interest UL, and it may earn a 3% or a 4.5% interest rate under a fixed interest concept.
Mm-hmm.
So traditional UL is going to give you some money, some growth.
Right.
That's better than the bank. So having that fixed interest account is a value, but again, you're only getting 3% or 4.5 at most. So the IUL is going to give you that market growth. It's going to give you a piece of that market growth up to a cap.
Now, let me ask you this. Would you say the IUL is really taking the place of the UL? I mean, I know there's a variable universal life, there's index universal life, and then, of course, there's universal life. Universal life was the first of the universal lives to come out. That was the first one. All right. And then the I don't know which one came next, if it was the IUL or the variable, but it seems to me, and it may just be me talking, that the IUL is really replacing the UL.
Oh, absolutely. Well, in my opinion, the UL product basically is just permanent term.
Okay.
So universal life is just really cheap whole life insurance. It's more like permanent term. It's really not designed to give you any type of overfunding maximum limits to be a large amounts of cash value for retirement.
Right.
It's more of a fixed interest product, as I said, basically permanent term. And so, in my opinion, that's not really a growth product either. That's more of an insurance product. And so, universal life is more just a fixed. And now, variable life, of course, was the second step. UL was the first step. Of course, we all had traditional whole life. Then we had UL. Then we had DUL. Now we got IUL. So understand these universal life products, the evolution of the universal life concept. Mm-hmm. Now we're at the top of the pinnacle with the IUL, and that again is the key piece, understanding the evolution of the product. So we talk with the insurance professional, they can help you understand, of course, whether or not you might need just a traditional permanent whole life, whether you might need just a permanent term universal life, whether or not you might be a variable life customer, or whether or not you might be a index universal life. So my question is it really comes down to risk. What type of risk tolerance do you have?
Right, yeah.
And if you have really a low risk tolerance or a moderate risk tolerance, then the IUL is a perfect fit. And so that's where I look at people and ask them about their risk tolerance. And so now, if you're in a 401k, most folks are not aware that is a very high risk product, one of the highest risk products in the industry. So we have the bulk of America today. Corporate America has basically blindsided America by putting everybody in the IUL, not understanding you're in one of the highest risk products in the industry.
In a 401k, rather, not in the IUL, but in a 401k.
In the 401k, that is correct, because you can effectively lose 50%, 60%, 70%, 80% of your money. Who in the world would want to lose half their money? And then when you encompass the tax feature, I tell my clients, or in a class, if I'm doing a class, just take out a sheet of paper, and then we're just going to talk about the value of a dollar. And most folks really don't know the value of a dollar. And what is a dollar in your 401k? Is it really a dollar? A dollar of what? A dollar in your 401k is not a cash. It's not cash. A dollar in your 401k is a dollar of stock value.
Right.
How do I get transfer it? How does it become cash? You have to sell it. You have to sell that dollar of stock value in your 401k to get a dollar of cash. But then anything you got to sell depends upon the market value that day or that moment of that product. So it's like you're trying to sell a piece of real estate. It depends upon the market value. So that dollar stock value depends upon the value that day when you go to sell it. Then you have fees on that dollar that
associated with that 401k. Exactly.
Transaction fees to sell that dollar of stock to make it a dollar of cash. Then you have taxes on that stock dollar, and after you pay those, you pay your fees, you pay your taxes. Then you end up with a dollar of cash. But a dollar, but your IUL is 100% cash. All your money is cash. So now you're dealing with, again, 100% dollar versus a 60% or 70% dollar from your stock transaction. So we have very limited understanding of really what are you trying to build, stock dollars or cash dollars. Now, in IUL, you're building cash dollars, 100% cash, and that money is available for you to be able to grow. What you have on your screen now is one of the picture of how we like to show people really the two stories of America, understanding the code, the tax codes that govern how you grow money for the most part in this country. And those codes are either qualified codes or those codes are non-qualified codes. And you need to be aware of both buckets. It's okay to have two buckets, and you're better served long term. In the qualified bucket, we're talking about pre-tax dollars. The seed that you put in per month into your IRA, 401k, or 403b. Versus on the other side, we're talking about non-qualified dollars that you're putting in post-tax. That seed is post-tax that's going into your IUL. And that is IRS code 7702. And then, of course, you're talking about on the qualified side, your harvest on the back end is going to be taxable. So if you pre-tax that seed, you're going to have a taxable harvest. So again, on the non-qualified side, having that post-tax seed, you're going to have a tax-free harvest. So again, two types of seed, two types of harvest. Then, of course, and if you're in the market, let's look at your risk. As I mentioned in your 401k, you're in the market with funds at risk versus that non-qualified IUL where you're indexed to the product, no risk. When you're indexed to the market, no risk. So therefore, you're not subject to investment losses as you are on the qualified side. So here you have side by side the difference between the two versus no investment losses in the IUL. So powerful to not have no investment losses. Then, of course, we're talking about the taxable income when you retire versus having tax-free income. So again, from that harvest, would you rather have taxable income versus tax-free? Again, understand the cost of money. And then, of course, it's amazing that people are not aware. Most IRA, most 401ks most retirees run out of money in 13 to 15 years versus that IUL that's payable until age 100. So not having a business plan or long-term plan, not having basically a private pension plan, which virtually gives you that guaranteed income to age 100 like an IUL. Then, of course, the other issue on the qualified side, that money is uninsured. There's no protection on those dollars. Dollars are just subject to the market. Versus those dollars insured and tax-free on the non-qualified side. So qualified money is uninsured. All qualified money is uninsured.
Wow.
Versus non-qualified money being insured. Why is that important? Well, again, what happens if you just die too soon? Of course, it's so very important to have that money insured versus uninsured. Is your house insured or uninsured? It's insured. Is your car, is it insured or uninsured? Why would you have your money uninsured? Okay, are you independently wealthy or not? Are you insured or self-insured? And then, of course, you can add bank financing. That's another opportunity. You have no bank financing on the qualified side. people are just not aware. You have bank financing. Then, of course, we have living benefits. That's a whole different feature. If you get sick along the way, to be able to have that money, have a pool of dollars, have that death benefit paid to you in life, to get that death benefit in a check, and eventually have a heart attack, stroke, or cancer. Then, of course, on the qualified side, the majority of that money is self-funded out of your pocket.
Mm-hmm.
Have no bank involved in that. You have no leverage. Bank financing basically allows you to go to the bank and get $3 for every $1 that you pay into your IUL. So again, it's just a unique understanding how we have that's a key man products, and you have executive level planning, where now the bank and industry and insurance industry have merged, and the bank industry will support your IUL if you qualify. So again, the value of that piece is that on the qualified side, if you're self-funding it out of pocket, it generally takes you 25 plus years to get to $1 million. But it's so amazing that you can build $1 million in your retirement account in just 5 years using the bank's money. So how many years do you have to build your million? What is your date of birth? So if you think for people who are trying to catch up, the bank financing program is a fit for folks who are trying to catch up, because essentially it allows you to build $1 million in 5 years using the bank's money. So that's a whole presentation we could talk about bank financing products, how it works on the screen in another meeting. But just understanding these concepts of where you have the opportunities to get these type of other dollars and get these types of leverage money. So again, I use this tool as a tool just to help educate people. And so that you just see how you have these two buckets for folks. And so again, bringing this forward gives you a picture of the 2 ways to grow money, having these two buckets. I think so you can really start here by using this as a way to just give anyone the basic understanding of the IUL.
Wow. This is critical. And I like how you brought that up about the 401k, 403, 457. You're self-funded.
Yes.
All right. It's uninsured. All right. What a lot of people think, well, I'm working with that place. I don't have to worry about it. They have my money. It's protected. All right. But you know what? That's not necessarily true. I've sat across the table from people who back in 2008, 2009 lost their money in their 401k. So not only did they lose the money that they had earned, but they lost part of the principal. That the principal is the money that they put in. So they lost part of that money as well. Now, and that was with the 401k. That was someone putting all their trust in that company, and that company staying solvent, and the company not having any money problems or whatever the case. But back in that era, 07, 08, 09, a lot of companies had a lot of issues, and a lot of people lost a lot of money, even though they had it in what they considered to be safety place, or 401 or 403. I sat across the table from people who had 403Bs, and the lady cried, "What am I supposed to do? What am I supposed to do?"
Absolutely.
You know,
absolutely.
And look, all I could do was hand her a tissue from her own table, because I didn't, I was like, wow, what am I supposed to tell you? At that point, I was not involved with IULs. I was with a different company that all they focused in on was long-term care. Well, this lady needed long-term care, but she couldn't afford it. Not anymore. She couldn't afford it, So I like that. I like the thing that Tanya put up that showed the difference between a qualified and the non-qualified. And you're right. It's so true. And James brought it up. We need to help people understand, and we do need to educate them. I would love for us, but we don't have time today. I would love for us to talk a little bit more about the bank. All right, and how to accumulate. Well, the bank meaning the here it is. It's insured versus not insured, and then the other area I'd love for us to cover, which I think a lot of people like to know. Hey, I'm starting late. How much do I need to kick into IUL to not even $1 million? How much do I need to kick in to get to $500,000 or whatever?
No question about that. It's so important as well. People get not quite clear when you say index to the market. What does that really mean? So what you have to do is to show folks their historical performance chart. And you should, and of course, anyone when it comes to talking about growing money, you always want to try to look at what is the historical performance of your product, even your 401k. What does it look like for the past 20 years, for the past 10 years? So having the historical performance chart, and I know Tanya, who seems to be back with us, can put that on the screen or not, but I had a chance to just review with her the historical performance of her IUL. And if we could talk about that for a moment, I don't know, do we have time for that or not, if she can even share with us that. No, not yet.
Share.
Mm-hmm.
Can you pull that screen? Oh, wait a minute.
I can't pull it up, Tanya, because I'm not in as a host. Just as I'm on through the link.
Oh. Okay.
There it is. You just had it. That's
one.
That's the pocket knife. No one. Yes, that's the one.
Okay. So yes,
you're gonna have to enlarge it though, Tanya.
I'll give it a try.
Excellent.
Go ahead, Mr. Clark.
Well, if you could just page up a little bit, and of course, what you see there, it says historical performance, and this is and if you look at the very top there, this product shows you the 20-year period, the past 20-year period. This particular IUL has a S&P account. This product has a gold account. This product has a real estate account, and this product has a bond account. So you have all four of the investment marketplaces to grow money. And it shows you the difference between in the market versus being indexed to the market. Mm-hmm. So I looking at that chart here, Tanya, if I can enlarge it just a little bit more, I can't really see the numbers there. But I'm looking at 2008. If you go to the middle of the page, and as the gentleman was mentioning right there, thank you, 2008, if you're in the market, S&P, what happened to the S&P? What happened to your stock account in 2008? So look at that 2007 to 2008, the S&P lost 39.93% of your money. Mm-hmm. Mm-hmm. You had $100,000 in your 401k, you lost nearly $40,000 that year. Now, if you had $100,000 in your IUL, that you'll have a floor. So your IUL stops at zero. Your floor, you don't make any money. Well, in this case, you make 0.25%. So you still have your entire $100,000 in your IUL, and you made 0.25%. So being in IUL, you have a floor. Now, you also have a cap. So let's go down to 20. Let's look at the last year. Let's look at 2020. So if I look at 2015, 12, 15, 19 through 12, 15, 2020, the S&P marketplace did 15.77% in your 401k. Well, that's a good year, but you still have risk, right? But look at your IUL. It has a cap. You earn 12.5% in your IUL. So that's a good return to have no risk. Well, let's the next two columns. Let's look at the gold marketplace. The gold marketplace did 25.22% in 2020. Now you have a cap of 16%. So in your gold fund, it's been indexed to the gold marketplace. You earn 16% in your IUL with no risk. Okay, and then that's a beautiful thing. But let's look at the real estate marketplace. In the real estate portfolio for 2020, basically it was just only earning 1.73% in the real estate portfolio. And you have a spread, you only end up with 4.8% in your real estate account in your IUL. And then in the last two columns, you have your bond account, where basically the bond market lost money last year, but because you have a floor, your bond account in your IUL stopped at 0 and you got 0.25%. So here you have one IUL product that has 4 accounts. It has an S&P account. It has a gold account. It has a Dow Jones real estate account. And then you have a Barclays Trailblazer bond account. So this gives you, in my opinion, one of the top IULs in the industry. This basically, if you page up Tanya, this is Tanya's IUL. You see her name there at the top. So this is her IUL.
Tanya, I want some money.
So we put her in this product. So she has been growing this product, and her face amount is $500,000. So if she dies too soon, we're going to pay her beneficiary, her family, $500,000. If she gets sick along the way, we're going to pay Tanya nearly $500,000 in living benefits if she has a heart attack, stroke, or cancer. And if she lives too long, depending upon her allocation, of course, she can reallocate her money.
That's right.
And after each year, she gets this statement.
Look at that smile.
If she lives, she's going to have $500,000 of cash value in her IUL if she keeps building and overfunding. But if you look at the bottom, let's look at the 10-year average and the 20-year average. Folks are just not aware the stock market in the last 10 years is only done 11.58%. In the past 20 years, the S&P has only done 5.31%. Let's look at the index side. The last 10 years, the S&P index IUL has done 8.65. But look at the last 20 years. The last 20 years, the IUL has outperformed the S&P IUL without any loss, has done 7.69% in the last 20 years. So the IUL has outperformed the marketplace in the last 20 years. Even the gold fund in the last 20 did 10.10%, but the index account gold fund did 9.70%. So my point being, why take risks when you can get the earnings at no risk? Even if at the bottom there at the real estate account in the last 20 years at 8.3% adverse in the market with risk versus 8% in the IUL with no risk. Now we only had the bond account for the last 10, not the last 20. But look at the bond account; it's done only 6%, 6.5% in the market with losses versus 13.08% indexed to the market with no losses. So the IUL bond account has outperformed the market. So folks just have not done their research, not done their historical performance. So when you have that 401k guy or that mutual fund girl or guy talking about the market growth, fine, I get that. Give me your historical performance for the past 20 years. Let's compare that to the market performance of the IUL. The IUL is 20 years old. So it's so amazing
Tanya,
to
stop
me.
sharing. There you go. Go right ahead. I'm sorry, Mr. Clark.
That this industry is 20 years old. So you have to have the historical performance. So Miss Tanya is a smart girl. So that is something that we use. So again, that's a slide that you can put up and show folks all the dollars. And then, of course, those results are based upon after the cost of insurance. Though that in the IUL, that return, again, folks are not aware, again, of the index products, how they really work. But again, this is where you have this show to help folks grow, do their research. But again, once you have the proof, you have the historical performance, and folks again get caught up in fees and cost of insurance information. That's okay. Everything has a cost. There's a fees and costs for 401k.
That's right.
Again, an IUL is designed to serve you and protect you in all three phases of your family protection. So we talked about the three phases of protection. What if you die too soon? What if you get sick along the way? And then what if you live too long?
Hey, with that, we need to wrap it up. We are over our time. But the engineers are kind enough to let us extend a few extra moments. Hey, folks, listen, join us next week. I don't know when Dr. Clark or Mr. Clark will not be with us, because we're going to have to bring him back. You just know. Hey, listen, there's a lot of information here. I like a lot of the comments that I've seen from people. I want to encourage you to do something. I want you to share this. Let's get this information out. Let's get this podcast, this streamcast out. Like us on Facebook, like us on YouTube. All right. We want to let you know we are here for you. We are only here because you are there. And we want to thank you for being there. We thank the engineers at ATR for being patient with us, for allowing us to get this extra information out. Man, I had some computer problems earlier, but I'm glad I was able to get in on this show. Tanya had some computer problems. I had to come in the traditional way, but hey, I'm here. But nevertheless, we want to thank our regular guest, Mr. Goodman, for being here, and then others, and then Pam seems to become a regular now. So look, we're so glad that you folks are here. Be with us next week. Don't forget, be with us next week.
For IULs one more time.
One more time. We've got to tackle this thing again.
There's gonna be a fee.
All right, we got to tackle it again. We're trying to go one more time. Maybe two more times, but we're trying one more time. Hey, listen, nevertheless, thank you for being with us. With that note, God bless. Look forward to seeing you again.
Have a good day.
Have a good day.